things to keep in mind this year is Certified Public Accountant Joshua Jensen. Thank you so much for being with us here.
CPA Joshua Jensen.
Net $100,000.
Finance Analyst Joshua Jensen.
Business analyst and CPA. And I mean, really, this stimulus bill, Joshua, thank you for joining us.
JJ the CPA here. Testing 1, 2, 3.
JJ the CPA here. Hope you are doing well. Here's the latest.
JJ the CPA here. Wanted to visit with JJ the CPA here. Hope you're doing well. So today, JJ the CPA. JJ the CPA. Are we still waiting to file for?
Never met a CPA.
You've never met a CPA quite like me. JJ the CPA here. Hope you're doing well.
American CPA. 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 You've never met a CPA quite like KK. America's CPA. You've never met. JJ the CPA is here.
Small business owners, including the self-employed. And so the videos that I've been putting out are hopefully helping you with that. We're going to talk about a few of those today. I want to tell you about some upcoming deadlines, get you a little caught up on some things that have been going on, wish you Happy New Year and some of the things that we were doing, and then go into some Q&A. So, hey, just get a little business out of the way. We've got our January deadline. So coming up on the 17th now of January, the fourth quarter estimated tax payments are coming due. Now, what that is for those of you that either don't have enough taxes withheld from wages, or if you're self-employed, well, if you don't pay yourself wages, meaning you're filing a Schedule C, there's no way that your taxes get paid in otherwise. And so estimated tax payments are something that does need to get paid in evenly throughout the year. But here's the thing. We're at the end of the year, as in we're now into 2023. So the IRS wants you to pay in whatever it is that you're expecting to owe come the 17th of January. All right. So Amanda's here today producing. We are kind of getting some of the kinks out. We've got a lot of pictures that were thrown up today to go along with it. So with that, Amanda, I will go through the next thing, which is the 1099 due January 31st. And with that, I've got a video that is coming up. Pop up that previous one, if you would, Amanda. The one that's got the black right there. Yeah, go ahead and leave that up for just a second. So for those of you that have paid somebody over $600, and I'm talking about out of your business as a self-employed, then you're probably going to need to send them a 1099. There's a lot of exceptions related to that. So the next picture is a video that you can look for that I put out where I run through the details. And I'm going to let you know I've got 3 different videos that I put out. One's 8 minutes, one's 18 minutes, and one's 45 minutes. For those of you that maybe already are familiar with it, you want the short version. For those of you who are like, well, I kind of know, but give me a good refresher. And then the 45-minute is going to take you A to Z in terms of, well, what software and what forms and exactly how to go about that. But you don't want to miss that, because January 31st, you need to get these out to the recipients. as well as then get filed to the IRS. Now, we are 1 week into tax season, and so I am going to be putting out a weekly video. So I released that video yesterday. And some of the things that I'm going to be putting out there will be basically, well, what's going on right now and what should you immediately be getting ready for? So small business owners, self-employed, tax pros, I think you'll get a little something out of that. The first one, there was a lot to cover. So check out that video. It also will help, I think, for those fellow tax pros. We're at the time where we're into tax season and we got phones ringing starting soon. And we've got emails coming in and texts, and we're trying to meet deadlines. That maybe a quick tune in, make sure that we're all staying kind of in step with tax season, if you will. So a couple of things that I brought up in the seminar yesterday was what you can put in for retirement. So for 2022, here's the dollar amounts that you should have already maxed out through wages, but gives you a heads up of what you need to prepare for if you're going to put money into an IRA or a Roth IRA. And then here's the amounts for 2023. The reason to pay attention to this now, especially for the simple and the 401k, is that you want to increase your withholdings right now so that you're able to easily max out as you move throughout the year. But I talk further about that. And that item right there, the retirement, in the body of this video, you'll find a link. You don't have to give me an email or anything, but you can find a link to go and actually get that little spreadsheet that I put together. Now, what's coming next? Tax documents are coming. I did put together a video that came out today with that, shot it while it was about 10,000 feet up when we were in Colorado. And in that video, I talk about the checklist, but this is a checklist that you will be able to get right now. You can go in the body of the video. Again, you don't have to give me an email or anything to that effect. You can go right to my website and get that checklist. That checklist is, here's the documents that should be starting to flood everybody's mailbox here in the next several weeks. You know, what's interesting is that for most, you should have all of your tax documents in by the early part of February. The only thing that really comes much after that is those that have investments, let's say at one of the big brokerage houses. They have till February 15th to get you your annual statement of how much you earned in interest and dividends and stock sales and the related basis. And the reason I'm telling you that is that when these documents come in, open up the envelope. Don't give it to your tax preparer unopened. The other part is you want to make sure that it's complete, that it actually look like what it is that you thought. There's nothing worse than just blindly giving a stack of unopened envelopes to your tax preparer. They email you with the results and you go upon years after years and maybe something got missed or something got overreported. So take a little bit of time, open up those envelopes, but that checklist that I am providing here will give you kind of an idea of what you will want to be looking for. Now, I don't want to miss this. I want to tell you that this Friday, I've got a tax season boot camp. Now, right now, I've got a package deal where you get the next 2 upcoming live seminars, as well as then instant access to additional 5 seminars where you're able to listen in to kind of an update for individuals and businesses. But this boot camp, okay, we're going to have a little fun with it, as you can tell. And with that being said, hopefully we'll see you there. You'll see a link in the body of that. Keep that picture up just a little bit because I got to tape up our next little sheet right here. Should have already had that tape ready. All right, here we go. So now we got the business out of the way. So I hope that you had a wonderful holiday. I know that we did. It really was pleasurable this year. We were able to get together with family. We have a real tradition on the Jensen side of getting together the eve of Christmas Eve. So we've got, keep that up there for a second. We've got Cooper and his number one with him. And we've got in the back there, fellow CPA holding my nephew, Rory, but that's Reed. He's a fellow CPA. And we've got Stephen in the back, as well as then my sister, Anna, that's right next to me, and my other sister, Amy, that's between me and Chloe. And then we've got Brady and Harlow. So we were all together having a great time. And And then, yeah, where is Amanda? Everybody knows who you are, but yes, just in case, Amanda back there in the striped or check, no, not whatever it is, sweater. I see. Look at you, threw me off. I apologize. I apologize, Amanda. But I also wanted to just share that this year we did our annual tradition of going back to Colorado. We had a wonderful time with that. It's our favorite place to be. Amanda, why is it our favorite place?
Well, let's just show them.
All right. So we do have to figure out how we can have the video going and I can talk, but nonetheless, January 1st of 2022, I proposed to this beautiful woman that's on the other side of the screens here with me, Amanda. We are getting married this year, June 24th. So we're excited about that. When we were up in Colorado, we had the most unusual experience. And what was the name of the train ride again?
The Royal Gorge.
The Royal Gorge, which is about 30 minutes west of Pablo, which is in the southeast area of Colorado. And it was probably about 30 cars, the regular size train cars. We got to meet Santa. And then they had an observation deck, and we were just right in the middle of the mountains. So as you can see there, I mean, you would just be able to reach your hand out. You'd be an idiot to do it, but you'd be able to just touch the side of that mountain. But we had a great time out there. This is Amanda. She wanted to put this picture up there. Okay. But this is the spot where we got engaged last year, which was about 10,000 feet up. And one of the things that's so beautiful, obviously, about Colorado is their mountains. But when you go up to the mountains, we were in two different locations where we were able to do that. It's such a wonderful view that we got to see going up in the gondola. So we're caught up on the personal side. I want to make sure we're getting to some Q&A. And so really to get us off and running, I've got some very common questions that we've been seeing in the comments, if you will. And so the first one that I'm seeing quite a bit is, can you still get the ERTC in 2023? And I know that that's a little bit of a trick question because you're thinking, well, whoa. Especially for those that are familiar with the issue, wait a minute, the Employee Retention Tax Credit, that already ended, right? Well, you can still get it in 2023. I've got a video related to this. I've just given you the thumbnail of that. And I have a playlist that you can go and check out. But can you still get the ERTC in 23? Yes, but how? So if we bring up the second thing, it is based on wages. So if you'll bring up that second banner, it is based on wages that were from the 13th of March, 2020 through September 30th of 2021. So if you had wages that you paid during that period of time, well, then you're kind of in the running. Now, if your gross receipts were down appropriately or you had a governmental shutdown, well, then you probably are going to be able to get the Employee Retention Tax Credit. There's still time to get it. How? You file a Form 941X. So I've got a seminar step-by-step that walks you through this. It's instant access to the last seminar that I did. I've got an upcoming live seminar. It's no different content than the recorded instant access, but I literally walk you through A to Z. And I know some would say, well, you have to hire a tax professional related to this. I wouldn't disagree with that, but I would probably say anybody that's trying to get familiar with the issue should take the seminar. Why? Well, because you might find, especially for depending on the size of your business, that it's pretty easy, quite frankly. And so anyways, I walk you through it A to Z and how to complete the Form 941X and get that submitted. Now, the next thing that we've been getting a lot of questions on is if you finance your vehicle in your business, then how does the tax deduction work? And the answer is it's simply based on the purchase price. It doesn't matter if it was financed, if there was a down payment, or if there was a trade-in. So I've got a video that's up, several of them that have a vehicle. I did an expansion of this subject matter. But the thing is that if you're buying a vehicle in your business and you're now wanting to write it off, the question is, well, do I only get to write off what it is that I pay as I pay along? And the answer is no, because when you buy that vehicle, you own it. Now, we know we could all chuckle and say, well, no, the bank really owns it if you were financing it. But we know that they have a lien on it, but they don't really own it. So my point is that when you buy a vehicle for your business, whatever the purchase price is, so it'd be net of discounts and net of rebates, but whatever that purchase price is, that's going to then be the amount that would be your depreciable basis to take. So the IRS looks at that, and just like any other asset purchase or any other monies that are borrowed for business purposes, when you borrow the money, that's not a taxable event. But when you pay back that loan, that's not a tax deduction. So what I'm trying to say is that you have to separate the two issues. You bought the vehicle. Doesn't matter if you made a down payment, you did a trade-in, or financed it. Well, what was the purchase price? That's your depreciable basis. Then on the other side, if you traded it in, well, it may result in a taxable gain. If you financed it, well, you're going to make payments on that. Your principal portion won't be deductible because when you borrowed the money, it wasn't income, but you do get to write off that interest expense. Now, I do talk through that video on some other aspects related to that, but we've been getting that one popular question. And the last thing before we see if there's any Q&A for those that are tuning in live, which I so appreciate you all being here, is if you were out with COVID in 2022, can you still get that self-employment tax credit? What about for 23? The answer is no, in the sense that this tax credit, and I've got a video that I put out related to this that's been quite popular. I think it's gotten the second most views now on my channel, but it's the self-employed refund up to $36,220. Unfortunately, it got missed quite a bit. But what this is for Schedule C filers, for those maybe that also filed Schedule F, that had net income that was subject to self-employment taxes. So from the 1st of April of 2020 through September 30th of 21, if you were out with COVID, then you're in the running to be eligible for this tax credit. But it's not available if you were out with COVID after September 30th of 21. So it wouldn't be available in the fourth quarter of 21 or anytime in 22 or in 23. And it's not going to show up anywhere on your tax return for 2022. So how would you get this if you missed it? Well, you would go back and you would amend either your 2020 return, if that was the time period that you had this, or your 21 return. So you're filing a Form 1040X, meaning you're amending your return. None of your income and your expenses would change. Your taxable income wouldn't change. Your tax wouldn't change. What would change? This tax credit. And then you would be in a position to get it refunded. So it's a refundable tax credit. So how much time do you have left to be able to do it? You still have some time, but I'm just going to invite you to go watch those videos because I walk through the details related to that. But it is something that in my seminars that I'm doing, I'm reminding fellow tax pros to look back at the tax returns for those that had a Schedule C in 2020 or in 21, and was there this credit present on that tax return? We know we were all in very different circumstances then, so it's very easy that a tax professional may have missed it. Many weren't aware of it. We don't have to hold it against them. What we want to do is now just go back and get those dollars, that tax credit. So you can go back and amend it. But fellow tax pros, for those that are filing Schedule C, take a quick gander at it. Your client's not going to care that you call them and say, hey, I didn't ask you one question last year, and it was this. Did you have COVID during this period of time? Were you out? If so, then I think we can go back and get a tax credit for you. You should still charge for your time and effort to do that because they're going to be able to get some dollars back. Now, the credits, when you add them all together, you would have potentially up to $36,220 that could come back to you. So check out the couple of videos that I've done related to that. So with that, Amanda, we're ready, I think, to go to some Q&A for those that are on live with us today. Now, I am going to tell everybody that we discovered this about 15 minutes before we went live. So we're not going to do it today, but most likely when we go live the next time, this will be in play. But we have discovered how to now bring Amanda on camera to then ask the questions. But the biggest thing was, being a girl, she's like, well, I didn't know I was going to be going on camera today. Number one. Number two, you always look beautiful. But we also, number three, didn't have anything in her background. So she just has this plain white background wall. So we thought, well, we need to gussy that up, maybe with some Amanda gear, if you will. Amanda's written 2 books, so we can maybe have something up related to that. So with that being said, we know that, Amanda, when we first started going live, this was back in March of 2020, and it was really even before anybody really knew about JJ the CPA like they do now, which we sure appreciate everybody and their support. But we would hear from people like, well, I can't hear Amanda. And it was because we were on a laptop and Amanda was standing on one side and I was on the other. We had no lighting and we were just taking questions. And I think we might have had 4 or 5 people on. So wonderful to see we got 67 people on. Amanda, I do want to give a shout out. Probably should have done it earlier, to who is on live with us. I don't know if you just want to throw up the comments and that I'm able to see, and then I can just, if you just scroll through.
Yeah. Did want to see if see if people can hear me. I'm talking a little louder, but I'll give somebody there. CSR is on. I know that. So let's see if he can hear me.
Yes. So yeah, just pop to the top. I just want to give some shout outs for those that are on. So we got Card Shop Reality, number 1. Appreciate you being on. We got Greg, Roll Tide, Rob with Imagine That Toys, Stacy and Dan, and Blue Line Tax and Accounting Services. Hope you all are doing well. We got Richard Quinn, who's also, along with Rob, a member of Group 51. So excited, Richard, to have you a part of this. And then we've got Doug and Tony D, who's also a member of Group 51. Thank you, sir. Tony is out of Chicago. And by the way, with Rob and Tony D, we were able to spend some time together this last summer on the annual retreat for Group 51 members. We had a lot of fun. We got Jane on with us. Jane, hope you're doing well. And Maria, thanks so much. And I think I said hi to Stacy, but just in case, we sure appreciate it. Now, Stacy said no sound, so I don't know if that's... Figured it all out. Okay, so what did people miss?
Well, I think they missed JJ the CPA here because...
okay. So we need to pause a little bit. Yeah. Got it. Okay.
I got to unmute.
Okay, I see. Well, then I will wait till next time you give me the thumbs up there. But we got Sam, Marianne. Hope you're doing well. Marianne is also a fellow Group 51 member. Got Carol on with us. And, Blue Line, I think you're a part of Group 51. And that sounds terrible to say because I'm drawing a blank because I know we've had some consult together. But anyways, hope you're doing well. We got Joe on with us, fellow CPA. And Joe, thank you so much. I really appreciate it. Anytime we get CPAs and EAs that are tuning into this, fellow tax pros. We got Bob and we've got Patonia. No, that's not how would you pronounce that, Amanda?
You did a much better job than me. So.
Yeah, I'm from Oklahoma, grew up in Seattle. I went to public school. I only took foreign language for a year, which just means that I don't have a very sophisticated tongue. That also comes to eating. I'm just not a very sophisticated eater. So I apologize for not being able to get that right. But we've also got Joanne, and I'm going to guess on guns. I think that is how you might go with that. And we, let's see, I think, did we get everybody covered there? I think we've got Alyssa. Alyssa has done some consult with me, which we really appreciate. Card Shop Reality, always worth another shout out. We've got My Top 5 and Mario Johnson. He's had some great questions in the comments here lately. And we've got Tony Stewart as well as Tina Beard. Oh my gosh, Tina, how are you? Good to see you again. Yes, it is tax season. We got 51-6. Whoa, I like that. I think I already said hi to Bob, but just in case, we got Tony Stewart. We love JJ. Thank you so much for that. And yes. I love it. I love it.
one of our number one fans in the whole wide world, Mr. Kevin Hawthorne.
Kevin Hawthorne.
Who is actually, his numbers on his YouTube video.
Yes.
Has just grown and grown and grown.
Yes, yes, absolutely. Well, Kevin has been wonderful. He has been sending emails over time, and we will maybe get a little snippet of Kevin's YouTube video to share with everybody. But he works as a volunteer down with the busing system in Florida. And anyways, he's a great friend of the channel, great friend of JJ, the CPA, and Amanda. He always sends very wonderful, uplifting. There's a few more at the bottom. I'm going to give shout outs, and then I will go. So we've got, let's see, Zan G, and then Kevin. Yes, good to see you, my friend. Cherry or Cherie. And then we've got Sits 300. Hopefully I didn't miss anybody. So thanks for being here. Good to see everybody. So Amanda, what are our questions? And again, if you don't hear Amanda, I'm going to go ahead and repeat it. And then hopefully the next time we all go live, we'll be able to see this beautiful face that's right on the other side of this screen here.
CSR said that he could hear me. So I think that's good.
Okay, good.
All right. So the first question is from Blue Line Tax and Accounting Services.
Blue Line.
What are your top three tax current events that you are relaying to your clients for this tax season?
The first is you're fired if you don't get me your stuff by the end of January. No, I'm just kidding. Blue Lines. Wait a second. That wasn't the message I was looking for. If you've been watching my channel for a while, and especially if you've been to my seminars, you know that I really become an advocate for fellow tax pros, EAs, and CPAs with don't put up with any baloney from your clients. But I'm having fun there, Blue Line, because that is actually the message that we're getting out right now. First and foremost, we actually sent one right before the end of the year, which was, hey, tax documents are going to come in. Here's a one-pager checklist of what you should be expecting. And we really need to get these individual tax documents from you by the end of February. You should have everything by mid-February. And then with our small business owners, then we're encouraging them that by January 31st, they've got their books reconciled, that they have getting us their financials if they're sophisticated enough that they're doing their own, or we need their bank statements as soon as possible. So really, that's the first message that we're getting out to the clients, is to really wake them up. And I will tell you this, most of you may know that you tuned in, but a year ago and some months, maybe a year and 4 months ago, I had a mild stroke. Now, in the medical field, you'd call it a TIA, but it was a stroke nonetheless, had a blood clot and had some issues. It took me about 3 months to really recover from that. And the reason I'm just bringing that up is that I had to downsize my practice, unfortunately. But with the clients that I was lucky enough to continue to work with, most of them, they've been clients for 15, 20, if not 25 years. I really pressed upon them, hey, going into tax season of 22, so last year, I really, really need to avoid working overtime. And I really need to get your tax documents by this date for businesses, the end of January, and by this date for individuals, the end of February. And everybody beautifully complied, of course. And I will tell you this, last tax season in 2022, I was done every day by 4 p.m. I didn't start till 8 a.m. I took a 30-minute lunch. I worked a couple hours on Saturday. So I didn't work any overtime. But by getting in front of my clients early and reminding them to get us the tax documents as soon as possible, and then following up with them, we were able to get everybody done by April 15th. And I know last year, I think it might have been the 17th, but we were able to get everybody done except 9 clients. And those 9 clients, they were done other than we were just waiting on third parties to get us K1s related to that individual. So a couple of things there. Number one, I downsized, so that made a difference, number one. Number two, I've got clients that I've been working with for 20 to 25 years. But number 3, I really just kept communicating with them. Well, we've done that same communication, and I think that we're going to probably hit these same goals. I haven't brought on any new clients since 2018, so I haven't brought any new clients on this last year. The second thing that we're getting out to people is that we need to get the estimated tax payments paid in by January 17th. And then the third thing that we're really focusing in on right now is determining whether or not clients need to send out Form 1099s. Now, some of the clients that have a ton of those, we've just shown them how to do that themselves. Some that have maybe a ton of them, they don't want to do it themselves, but it's a little bit more than we want to tackle. Then we've got our payroll company that we send all our clients to. They can do the 1099s. And then we have some that we do them. And I think this tax season, we're going to get Cooper, my son, involved in helping with that Form 1099. So get us your tax documents in, estimated tax payments coming due January 17th, and then figuring out on these 1099s that need to be sent out. That way, hopefully, when we hit February, we are now working on all the business returns, if not already. And I'll tell you this, we had a client that on the first day of the new year, first business day, already sent us our financials. Now, to be fair, they've been a client for 25 years, number one. Number two, this was a trained accountant that keeps up with their books. And but nonetheless, we have already got one tax return in the bag. All right, what's our next question, Amanda?
Our next question is from Andrew in California. Hi, JJ. Good to see you. Hey, I know this is off topic, but do you know if there are any deductions related to surrogacy? IVF would be with a donor plus gestation, I can't say that word, carrier. It's 200,000 plus.
And who's this?
Andrew in California.
Okay, this is Andrew, longtime friend of JJ the CPA. I think this is Andrew, the attorney that's in California. Confirm, please, is this the Andrew? We know that you're out of California, but are you the same Andrew that is an attorney? Let's see, did we get any response related to this? He just smiled. Okay, so it sits 300. With that being said, hopefully you and your new bride are doing well. I think it's probably been now a good year, if not a year and a half or so. So what's the answer to that? That is something that typically can fall in as a medical deduction. That's on Schedule A, and that would be then subject to the 7.5% of income. So with that being said, I know some may have the opinion that that's elective, if you will, and therefore some may question whether or not you would be able to tax deduct that. But I've not come across anything within the IRS rules and regulations that when you're having expenses related to conceiving or having a baby, that those would fall outside the purview of being a qualified medical expense. Now, with that also being said, for those that have an HSA, that's a health savings account, dollars that you're putting into that can be used for everything that's medical related, not just what's not covered by your health insurance company. So it can cover contact lenses and glasses and dental, but also would be able to be used related to this. And the reason I bring that up is that I do know we have had a client, they had money in their health savings account, that HSA, and they inquired whether or not they could pull money out of the HSA and then use it for these expenses. And so when I looked at it from that angle, it is a qualified medical expense to pull out of the HSA. So I don't know why it wouldn't be a qualified medical expense to deduct on Schedule A. That's your itemized deductions. And with that being said, it doesn't fall under adoption. Of course, I'm telling you an obvious here. But what I'm also wanting you to know is that medical expenses are deductible in the year in which you pay them. That also may seem like an obvious, but it doesn't need to be that it was a successful set of circumstances to be able to deduct it. And sometimes with the adoption, depending on what year we're looking at, there's a provision of, well, you don't get to deduct it until the year in which the adoption was finalized. Now, I know that there's different circumstances where you can deduct it as you go along, so I'm not going to get into all those details. But all I'm trying to tell you is that with medical expenses, and this question would be no different, the year in which you incur those, or I should say pay those medical expenses, then that would be the year in which you'd be able to deduct them as a medical expense. It doesn't need to be once the baby's born, then that is when you're able to deduct those expenses. So best of luck to you all on that. And so great to hear from you. And I recognize, I'm pretty sure that that username, or whatever you call it, the handle, that is the Andrew. So what's our next question? And thanks for being here, everybody. We got 72 people on with us. So appreciate that. I do want to let everybody know I'm going to interrupt us here in a little bit. I want to talk to you about When I Had Cigars with Gary Busey. I want to talk about my good friend, Josh Jalinski, who is the financial quarterback, because we're going to have him on live. I can't have anybody else on live as our first guest until I have Josh Jalinski on with us. So I'm going to talk a little bit about him as well. But Amanda, do we have any other questions?
We do, but can we just talk about the miracle and like what just happened, that you just heard this random question and knew exactly who these people were? And that you guys might think this is a one-time thing. This is all the time. Like, he has the most incredible memory and can just hear little bits and pieces about something, and then can tell you something that happened 30 years ago, and what he was wearing and where he was sitting and what the temperature was outside. Like, his memory is amazing. So
Well, thank you.
Our next question is for Mr. A.
Mr. A, hope you're doing well.
Random tax question. If you've been taking the home office deduction and some carryover losses have accumulated due to not having income, what happens to the loss carryover when that home is sold?
Well, great question on that, because many probably don't know, but when you take the home office deduction, you're now using your home, and this would be for those that are filing a Schedule C or possibly a Schedule F. And when you then take this home office deduction, you're then allowing part of your home to be depreciated. Now, a couple of things to note. There's actually 3 ways to determine the home office deduction. The first and the simplest way, number 1, is right there on the face or page 1 of Schedule C, which is how many square feet in your home are you using for the purposes of having a home office. Multiply that by $5, and that's your deduction. No more than, though, $1,500, meaning it can be up to 300 square feet times the $5, which would be a max $1,500 deduction. Now, someone may correct me on this, but my understanding is when you use the simplified method, there then is no recapture of any type of depreciation when you sell your home. Now let's go to, if you use one of the other 2 methods, there's the indirect method and the direct method. Indirect method was really what everybody used for the most part before they came up with what was called the simplified method. The indirect method would be, well, what are the expenses related to your home, which would be typically the interest, the real estate taxes, your insurance, your maintenance, other types of utilities, and then you would determine as a percentage, meaning your square foot of your home office that qualified compared to the overall square footage, what was that percentage, multiplied then by these expenses that you've gathered up related to the home. And then that would be your home office deduction. That third method is a direct method, which is much more complicated, in my opinion, because you are then identifying very specific expenses related to that home office. So with that being said, if you're using the indirect method or the direct method, then there is a depreciation component, which this Mr. A has indicated that potentially is a part of their tax circumstances. So with that being said, you would look at then of the loss carryover, that's the depreciation component. If you knew specifically what that dollar amount is, which it sounds as though you do, and if somebody was really looking at that calculation, they would know what that loss carryover is, and then of that loss carryover, how much of it is related to depreciation. And here's then all the way to the end, but actually to the point of your question. So when you sell an asset, whether it's a car or your house that you've used for business, you have to recapture the depreciation. What does that mean? What it means is you're going to take, well, what did I buy this asset for minus the depreciation that was taken? And therefore you have what's called an adjusted basis. So I'm going to use a simple example. You bought a home and it was $250,000. You lived in it for a long time. And over that time period, you took $10,000 in depreciation over that time period. So when you go to sell your home, you would say, well, my tax basis is my original basis of $250,000 minus the depreciation that I took. Now, I don't want to get too deep, but we know you get to add improvements and subtract closing costs, but I'm trying to keep this simple. So your cost basis for tax purposes would be that original $250,000 minus the $10,000 in depreciation. So that means that your tax basis in this example would be $240,000. What's interesting is that when you are accounting for depreciation, the law indicates that it's depreciation that was allowed or allowable. So in this circumstance, that's where the allowable comes into play, meaning it was allowed, it was allowable. You didn't get any benefit from it, but nonetheless, you would have this recapture. However, all the way to the end, if you did not realize a tax benefit, so you have that depreciation that continues to carry over and you never realized the depreciation benefit, as in it was a loss carryover or it was depreciation carryover, then you're going to add back. Sounds like we're making this more complicated than it is, but that's just the tax law. You're going to add back, though, any depreciation that you didn't realize to the extent of your basis. Now, that would be on your personal residence. So with that being said, let's just say for grins, in my example, that of the $10,000 of depreciation that you took over time, $1,000 of it you never benefited from. It was a carryover in this loss that you're talking about. So your basis would be $250,000 minus $10,000 of the depreciation that was allowed or allowable. And then you would add back $1,000 that you never got to take advantage of. And therefore your adjusted basis would be $241,000. Now, I want to point out to those that if we are talking about depreciation that's taken in a business, not a home office, and there's a loss carryover in a business, that is very different from what I just indicated to you. So you'd have to look at the rules and regulations. What we're talking about here is a personal asset, okay? And this is a personal residence. And so if you have a home office and it's your principal residence, meaning that's where you had your home office, right? The thing I want you to note is that we just talked through what that basis is, $241,000 in my example. But then you would compare it to what was the sales price of your home minus your closing costs, which would be minus any expenses that you incurred to get it ready for sale, minus the commissions, etc. And you would come up with a net sales price. So let's just say for grins that now was sold for $300,000. So this home's being sold for $300,000. The basis is $241,000. Why am I going through this example with you? Because one of the major exceptions under Code Section 121 is that when you sell a home that's your principal residence and you've lived in it at least 2 of the last 5 years as your principal residence, then any gain up to $250,000 per person, so for a single up to $250,000, married filing jointly up to $500,000, that gain's not taxable. So why did I go through that big example with you? Well, Mr. A, what you may be looking at here is that when you're now figuring out your tax basis and you're comparing it to the sales price adjusted for your closing costs, if your gain, married filing jointly, is less than $500,000, then you're not going to have any tax consequence anyways. If you're single, then it would be $250,000, meaning that gain is of that amount. So the only time that really it comes into play is if your gain on the sale of your home is going to be more than that exemption under Code Section 121, or if you're in a set of circumstances where you've not lived in that home for the last 2 years, or I should say 2 years, at least of the last 5 years. So bottom line is, here's the real simple answer. If I was on another show, Amanda, whatever depreciation you didn't take advantage of, it wouldn't be ultimately a recapture. It wouldn't be ultimately a reduction in your basis. So great question on that. All right, Amanda, what do we have next? And then I want to tell people about Gary Busey.
All right, our next question is from Rob with Imagine That Toys.
What's up, Rob? Good to see you, my friend.
If we owe fourth quarter estimated tax payment, how do you suggest we send it? Pay it online or send a check?
Well, I'm kind of old fashioned until recently, but I love now having clients pay online. And with that being said, I appreciate you bringing that up, Rob. So you would go to irs.gov and you would say, I want to make an IRS payment. You're probably actually going to find it right on page 1 of the irs.gov website, make a payment. And you can make a one-time payment. And when you click on that, it's going to ask just a few questions. If you're at irs.gov, then you should feel safe entering in what they're asking for, which is your social security number, mailing, your filing status, and a couple other questions to verify your identity. Then here's the real key part. When you go to pay online, what you want to be mindful of is to ensure that you're coding this properly. What does that mean? Well, it's going to ask you, what are you paying towards? So you want to make sure that you're paying as an estimated tax payment, and it's going to ask for what year. So since we're in fourth quarter payments, that's for 22, but see, we're actually in 2023. You all know that. So don't make the mistake of making a payment online and applying it to 2023, because the IRS will not move it. It'll be stuck and applied to 2023, and you really wouldn't get credit for it except for the actual year that we're in. So what I like about your question, Rob, is that I've had people say, okay, hey, listen, when I'm online, but what year do I select here? And it's what year are you paying your tax towards? Then that would be the year that you would select. So you would do an estimated tax payment. That's 1040 ES for estimated, and then pick that tax year. And then it's going to ask you for your banking information. You can pay by credit card, but take note, the IRS is going to charge some fee on top of that, because they're not there to help you get points, and they're not there to help you finance what it is that you have to pay. So we tell clients, if you're going to pay by credit card, don't. You need to just pay by bank. But I will tell you this, 95% of my clients, they're my age or maybe a little older, maybe a little younger, and they just still mail the check in. So it does need to be postmarked on or before January 17th. If you're paying online, then you need to make sure that payment's made on or before January 17th as well. Well, why is it the 17th? Well, we know that it's actually due on the 15th. That falls on a weekend. And Monday is Martin Luther King Day, and that is January 16th. So that's a federal holiday, which means that the next business day is January 17th. So that's why that is due there. And I meant to remember, but there was a fellow CPA that I did a post, and he said, hey, don't forget that we actually get till the 17th this year. So at the end of the day, I would say online, if you are able to get that done. Part of that is that you're going to get a confirmation of it. You're going to get a confirmation number. You'll get an email, and you'll have then the peace of mind that it was made. But I'm going to tell you this, the clients that I'm working with that are a little more old school, and it's just kind of more out of, for fun to say something like this, because it's not much of a big difference. But I have clients that are like, I'm not paying online. I'm going to mail them a check, because as long as that's mailed on or before the due date, so it's postmarked on or before the due date, then it's considered timely paid. And they then are going to get that check. They got to open up the bank or open up the envelope. They got to run it through the account. And so I got to hold on to my money just maybe a week or 10 days more. So that might be the only reason that some of my clients still like writing the checks, is they're like, hey, I get to hold on to my money for another 10 days. We all know that doesn't make really any difference related to that. So Rob, hope you're doing well. And you probably all know, but Rob is a fellow member of Group 51. Consider him a great friend. He was also the first one that we met with. He and his family own Imagine That Toys up in Kansas. Gwen, Al, and Paula is his family. Gwen started Imagine That Toys, I think at this point, 15 years ago. And when Rob retired, everybody should know his story, but when Rob retired, he moved down and decided to help with the family business. And with that being said, we did a reality show. You're right. Amanda and I, we did a reality show in the summer of 2020 just on our YouTube channel. And they were the ones that we went up to visit. And we went up to their toy store and met them and spent the day. And then we shot some videos. And they've been great friends ever since. And we interact quite a bit. Rob is also a great resource for emailing me to say, hey, here's something that just came up. So especially during the pandemic when things are moving very quickly, really appreciated Rob sending me things that had just come out on the wire, especially related to the EIDL and the PPP when we were dealing with all that. So Rob, hope you're doing well. And I know Rob's going to be at the boot camp this Friday because as a member of Group 51, they just get to attend all my seminars. They get to do consulting with me. All right, Amanda, what's the next? Oh, yes. Group 51. Yes, let's bring it up. So this is a membership for all of 2023. Now, for anybody that cares, it's 56 hours of seminars. It does count for CPE. I have a monthly seminar. And what is these seminars that are a part of Group 51? It is what I'm telling my clients, but I'm not sharing on YouTube. And the reasoning for that is that when I do a seminar, I feel as though I have your attention. I'm able to give you a PDF. I know that I at least am able to present to you A to Z of what it is that we're talking about. The one thing I love about YouTube is that it's free videos other than the 3 to 10 seconds of ad space that you need to watch, which I appreciate you doing. But with that being said, I don't know how long somebody is going to even watch the entire video. I know sometimes I can be long-winded. Somebody's like, you know what, I'm just going to go on to the next video. But also when I'm doing a YouTube video, I don't know the audience. I don't have the ability to provide the information as in a PDF. And so all I'm saying is that as a certified public accountant, keyword public, I do have a duty to the public, which is to provide good information. Well, there's only so much that I feel that I can just put out there in general. So there's kind of a ceiling that we hit when we're doing the YouTube videos. So for me, I want to provide enough information to give you ideas to go to your tax advisor, or for fellow tax advisors, CPAs, EAs, always honored when you check out my videos. Just maybe another way to think about something, because I do the same thing. I got to rely on other professionals. But with that being said, with YouTube, there's only so much I'm going to be able to put into that video. And I'm not for hire. I'm not taking on new clients. Cooper will be taking on new clients, but that's really probably a couple years down the road. That's my son. But the seminars then is the next best thing. And with Group 51, pull that back up real quick. You are able to also consult with me. Now, there's an asterisk there because in your fee, it's not consulting for free. I don't work with my clients for free just because I do a tax return. So whatever the consulting is, then I would be able to help you. I'm not going to be your preparer. I'm not going to be your CPA. I'm not going to be able to do your tax returns, but I can consult with you, and you're just going to pay me the hourly rate, which is what I charge my clients. And then not a big deal, but we have a private Facebook group and nothing really big deal there other than it's just a way for me to keep up with everybody in Group 51. Amanda, I do want us to go through some other questions. Do we have still a few more to go through?
Yes.
One more thing on Group 51. We only have 31 spots left. I originally, if you want to pull that graphic up, I originally had told Group 51 that I wasn't going to shut it down. But I got some good feedback related to that. And we've kind of become a tight-knit group. There are always those that either just don't need to be a part of the group anymore. So we do have some openings. Those that were a part of Group 51, I didn't put a deadline this year, so I assume there'll be more people signing up from the existing Group 51. Last year, I had a deadline of December 1st. Now I have a deadline of January 24th. So once we hit 50, I'm going to close it. So hopefully those that want to continue in Group 51, those that are tuned in right now, I already know you've signed back up, so I appreciate it. But anyways, it's just going to be 50 members. That's it. And then that'll be all the seminars that I'll probably be providing until we get to November and December. So let's talk about Gary Busey, Once Upon a Time in Malibu. So when Cooper graduated from high school, I took Coop and his longtime pitching coach, Ryan, out to Malibu. Now, we were all done with high school baseball, and so there could be no one pointing to favoritism to taking his pitching coach on a trip. But Coop's pitching coach was much more than that. He was, in some ways, a second father to Cooper, which I'm so thankful for. Not that he needed another father, but he just really had that figure. Ryan could be harder on Cooper because he was a coach. You could yell at Cooper. But with that being said, Cooper had a lot of respect for him. And we know that Ryan is just part of our family. And with him being a pitching coach, he had a background. He was a professional pitcher with the Boston Red Sox organization for 4 years. He's a big, tall lefty. And he also is somebody that's been Coop's pitching coach since he was 8 years old. So we wanted to do a thank you for him. So we went out to Malibu and we went to a couple of Dodgers games. We went to a Lakers game. But where we stayed, we found this little condo that overlooked the ocean in Malibu. And it was right across the street from this cigar shop. And when we went into the cigar shop, because we were all wanting to enjoy cigars, and by the way, Cooper was already of age. He turned 18 and then started his senior year of high school. But with that being said, we went over and we were grabbing some cigars, and we were just planning on heading back over to the condo and sitting out on the patio and maybe having a couple of cigars. With that being said, the person that was helping us with the cigars said, hey, up top on the rooftop of the building that we're in, we have a spot that you can hang out. Got some umbrellas that you can sit under, ashtrays. You have a wonderful view of the ocean, so you guys can go hang out up there. And we're like, okay, that sounds great. And he said, and by the way, we have a celebrity in the house that is upstairs. He said he's a regular here, so he's very friendly. So when we went up, we're climbing up. He wouldn't tell us who it was. When we went up and we got to that top level, the rooftop, right there, and there was probably only like 5 or 6 tables, a couple of extra chairs, but sitting at the table, probably no more than about 15 feet away, was the Gary Busey. And Gary Busey typically is known for some of the roles that he played in Lethal Weapon. He played the bad guy in Lethal Weapon, but he also played a cop in one of my favorite movies, which was with Keanu Reeves. And what was that movie, Amanda? I think it was not Riptide. It was, but anyways, he was an FBI agent. I don't know. I can't believe that I'm forgetting that movie. I went and saw it 3 times in the theater when I was in college.
Come on, CSR.
Yeah. So
Point Break.
Point Break. There it is. Boom. And I'm talking the original Point Break. And then, of course, Gary has been in a ton of movies and well before that. And what was interesting, though, is that I went right up and I quoted to him one of the movies or one of the lines from one of the movies that he was in. And that was from Point Break. And I quoted him a line that's actually has a lot of cuss words in it. So I won't repeat it here online, but it was something that stuck with me. And it was so funny, even though it had cuss words, that I have re-quoted that, giving Gary Busey credit for it. But I've re-quoted that a number of times when I was really hungry. So it was the scene where they're undercover and Gary Busey is hungry and he says, "I'm so hungry, I could bum." Anyways, all that being said, I went up and quoted that to Gary. He was blown away. He looked at me and he said, "How did you know that line?" And I said, "Well, because I'm a big fan." He's like, "Well, sit down." So we sat down and we were with Gary for about an hour and a half. We were so sad to leave, but we had to get to a Lakers game, which we were almost late for. But we sat down and he couldn't have been more down to earth. Now, I know some will, in the media or on social media, talk about Gary and his harebrained ideas about things. But I will tell you this, when you sit across from a man and you chat with him face to face, and not to mention having cigars, he was having a cigar, there's some kind of different vibe that you would get different from when you are watching somebody on television and only seeing what it is the producers have put together for you to see. As we all know, he was on a reality show, The Apprentice, and he did have some crazy acronyms that he would come up with. But see, he is so smart, he made a book out of it. It's called BUSEY'S by Gary Busey. And we were able to, he had, this is a man after my own heart, because he was telling us about his book and I was like, "Oh, I'll have to pick up a copy." He said, "Well, I got one right here for you." So I got a link in the body of this video if you want to go check it out. But basically it's right here. He's got an acronym: Basic Instructions Before Leaving Earth. He had just celebrated a birthday, I believe, and he talked about one rotation around the sun. I think he was at the time, I think he was 72. But, many times, and I say this now on a serious note, many times people who have original ideas, people immediately point to and say, "That's a nut job." Or somebody that came up with something that was very creative and they have a creative way of communicating it. The norm is, the average is, the tradition is, well, they're a nut job. And so I think it's sad that Gary has somewhat of a chuckling following in some of the things that are on social media. Now, I'm not all saying that at all. Gary Busey, I think, has a lot of respect in a lot of the community. But when you see some of the things online, I think that it's somewhat unfair. And I think part of that came out of the way that he was portrayed in The Apprentice. Now, with that being said, Gary told us, which we didn't know, but he grew up in Oklahoma. He actually grew up, I believe it was just south of Tulsa. So he was a young boy, a teenager, a young man in Oklahoma. And so we had so much fun swapping stories about Oklahoma. He knew all about the OU Sooners and Oklahoma State Cowboys. But one of the things that he told me was, and I said, "Gary, tell me something that I may not hear from anybody else." Now, I wish I could remember the acronym, but he threw out an acronym and then told me what it stood for. And he said, "To be a great actor, it is somebody that can act in the absence of acting." Now, I looked at him and he said, "Don't you follow what I'm saying?" I said, "I think so." And he said, "A great actor is somebody that actually doesn't need to act." Now, why am I telling you that? I think that's probably part of what's made Gary such a great actor, is that he takes on the roles and he then falls into that role to where he doesn't have to act. So we probably will, for fun, just because I've become even a bigger fan of Gary and just found he was a real sweetheart of a man. He was very genuine. He asked us a lot of questions about our lives and growing up and what our favorite movies were and what his were. And he just loved the classics. And he told us some stories of early Hollywood. But we are going to have fun, and I mean in a positive way, sharing some of Gary's museums throughout our live show. I know CSR will probably definitely enjoy that. So with that being said, Gary, thank you for now obviously he's never going to watch this, but in the off chance that his agent is like, "Oh my gosh, JJ, the CPA, America's CPA, just spent 10 minutes talking about you and how much he admires you. That would be a pipe dream that would ever happen. But nonetheless, Gary, I appreciate you. Thank you for your time. I felt like you gave us a little bit of yourself, and definitely enjoyed having cigars with you. I will tell you this, we did try and go back each night or each day that we were there, hoping to run into you again. So we're sorry that you missed you. But with that being said, Amanda, do we have any other questions that we want to run through?
Yeah. Richard Quinn, CPA.
Richard, my friend, how are you?
Can we get a copy of the K2, K3 letter that must be mailed out by January 15th?
Oh, I'm so glad, Richard, that you brought that up, because if you notice, I don't know that anybody would notice this, but the IRS has changed that. And so on the 28th of December, for the S Corps, I believe, and then I think it was on the 26th of December or 24th or 23rd of December, IRS came out and said, we don't have to worry about it by January 15th. What? So with that being said, I've got a couple of slides that are in my seminar. I actually have a couple of videos I just haven't released yet, Richard. So I appreciate you bringing it up, because I'll discuss it now. Now what the IRS is saying. So as of, 10 days ago. Now you're right. I know some would say, whoa. They updated the draft K1 instructions, and those are dated in early December. I'm not doubting you there, because when I go to the draft K2, K3 instructions, it has the big watermark that says December 2nd on one and December 5th on the other. But I'm telling you, those were not anything that I could find, because I did a couple of seminars throughout December, and I went back specifically to the K2, K3 instructions to double check the language to include in my seminars. So all I'm saying is that I finally came across it when the IRS updated the website that included that. So all to say, Richard, we are all catching up on this, but here's what the IRS indicated. We now have until the time in which we provide the K1 to that partner or shareholder in a partnership or S Corp to inform them that there will be no K2, K3. So there is, though, a deadline for those that want the K2, K3. So if there's a shareholder or a partner that wants the K2, K3, they must inform that partnership or S Corp by August 15th of 2023 for 2022 that they need a copy of it. Now, if somebody gets a K1 from a partnership or an S Corp and it doesn't include the K2, K3, well, they have until August 15th of 2023 to say, well, I got my K1, but I'm now going to need the Schedule 2 or Schedule K2, Schedule K3. So the takeaway here is that we don't have the January 15th deadline. So hopefully, when I found that out, Amanda and I were in Colorado, and I went through, I actually pulled over and took down all the posts related to that I had on Facebook, social media, everywhere. Took down the videos that were related to that. And at the end of the day, now we just have until the time in which we provide that K1. Now, it doesn't appear when I read the still draft instructions that this means that we have to provide the K1 by August 15th. What it indicates is that really the August 15th deadline is for the person who needs or wants that Schedule K2, K3. They have to give notice to the partnership or shareholder on or before August 15th to then request it. It doesn't change the fact that we would have till March 15th plus extension September 15th to provide the K1. And the IRS goes through and indicates what happens if somebody requests after August 15th. It also indicates what happens if the K1 was already filed with the IRS and then a request came from a partner or shareholder in terms of how to go about that. And I think the IRS has done a great job in the updated instructions in providing those details and examples. So that is a good part of the boot camp seminar that I've got coming up. And also, Richard, we don't have to provide a letter. It would just be a statement that is attached to the Schedule K-1. And what the IRS is indicating is that it literally would be like a sentence that says in the statement attached to the Schedule K-1 that no Schedule K-2 or Schedule K-3 has been prepared or will be provided. I would probably, with my clients, add to that language for those that are going to get K-1s that aren't clients of mine, that if you would like the Schedule K-2 or K-3, please request it on or before August 15th of 2023. So really simplified down, we just have to do an attachment to the Schedule K-1. And as long as that attachment's to the K-1, then we've met our qualifications. Now, also, and you probably know this, Richard, already, of course, and Richard is up in New York, by the way, so he's got all kinds of different deadlines that he's dealing with as well with the state and the city. But with that being said, of course, for somebody to, for a business not to send out Schedule K-2 or Schedule K-3, it needs to be that there is no foreign activity or very, very limited, meaning there's no investments, there's not any kind of foreign activity. It should be pretty straightforward in my mind. You either have foreign activity or you don't. I don't know what any confusion would be. Not that Richard would ever be confused by it. The second is that what's interesting here is that for partnerships, it needs to also be that all the partners are either U.S. citizens or residents down at that individual level. But that is not the requirement when we look at an S corporation. An S corporation doesn't have that second requirement. So with that being said, thank you for bringing that up. And Richard, thanks for being a part of Group 51 as well. Amanda, I know we told, or you and I were discussing before, how long do we want to go? We really want to keep these shows to about an hour. And one of the things I'll mention is that I don't yet have a set time of when we will go live. What I do plan to do is once I know that I'm going to go live at a certain period of time, then I will put it up and it will be on our it'll be on the main page for the YouTube, and it'll say next upcoming live. And then you'll know when we're going live again. Part of the reason for this is that for tax season, I've got to for sure, obviously, take care of my clients first and foremost. And so sometimes with meetings or going to clients or having to follow up with them or getting tax returns done, I don't really feel that I should commit to a set time and set days throughout tax season. So we're just going to be doing tax season together, which means that sometimes the waves are higher than they are other periods of time. So I'm just going to go live as many times as I can, or as many days as I can throughout tax season, and really try and keep it to about an hour. Now, I did a lot more commentary at the beginning. I talked about Gary Busey. I do want to continue to do some of those things because I want it to be somewhat of a talk show, but we'll probably be able to get to the Q&A quicker. Amanda will find that as tax season goes, is this going to be true or not? Who knows? Then I'll try and make my answers a little shorter. I'm doing this just because, I know we're all probably chuckling at that. But Amanda, we said we would try and finish up. We'd maybe go 15 minutes extra. So we already are at 15 minutes extra. The reason I'm saying this is we're going to go 15 more minutes. So I'm going to try and be as quick as I possibly can with my answers.
Okay.
So here we go.
I'll just need to get me a piece of paper over here that's just like, I'll get you a gong. Remember the show, The Gong?
Well, but the gong meant it was no good and you had to leave the stage.
Oh.
That might hurt my feelings.
Oh, that's true.
Yeah,
okay.
yeah.
All right.
I'm sensitive that way.
This is from CJ.
CJ, what's up?
If we travel somewhat, not a lot, how do we keep our business gas costs separate from our personal gas costs?
So if you're driving a personal vehicle, then what it's going to come down to is using the standard mileage rate. So when you use actual expenses, that is typically then the business owns the vehicle. So if you're an S Corp, partnership, or C Corp, the business owns the vehicle. So that business is going to pay for everything, all the gas, all the repairs, all the maintenance, the payment if it applies, the interest, the tag, etc. And then if the business owns a vehicle, it's a business vehicle, then at year end, the personal use of that vehicle going to the tables that the IRS puts out will determine how much of a taxable fringe benefit that owner or employee or partner has to pick up as income. So that's how it would work if it's owned by the business. When you say the question that the way that you just posed it, I'm going to go with the assumption that you are filing a Schedule C with your individual return. So when you file a Schedule C, you don't have to have that vehicle owned by your business, because there is no separation, at least in the IRS's eyes, between you and your business. So the vehicle can just simply be a write-off. So what I'm saying is that typically what you would look at is using that standard mileage rate. So I've got a couple of videos on that. And we know that there was 2 different rates in 2022. There's a new rate, which is 65.5 cents a mile in 2023. But that would probably be the simplest. It would probably yield you a larger deduction. However, you can still go with actual expenses. And what the IRS indicates then is you would gather up all the expenses related to that vehicle, the interest, the tag, the maintenance, the repairs, your gas receipts, right? And you would then add all that up and you go, okay, here's the total cost of this personal vehicle or this vehicle I'm using for business. We're talking Schedule C now. And then based on the number of miles that you drove for business purposes compared to your total miles, then whatever that percentage is, that would be then the percentage used to determine your dollar amount that you get to deduct related to those vehicle expenses. So as an example, with the Schedule C filer, if your actual expenses, and remember with a loan payment, only the interest portion is what you get to include in terms of the cost of that vehicle. And when you're doing actual expenses, you would be doing depreciation. If you're leasing a vehicle, then you would include the full lease price. With all that being said, let's just say for grins that total cost is $10,000 for the year. And now when you go, well, I drove 3,000 miles for business and I had 10,000 total miles for the year. Well, that means that you used your vehicle 30%, 3,000 miles divided by a total of 10,000 miles. So 30% was used for business. So then if you had 10,000 in actual expenses, then you would say, well, 30% of those is my deduction, or $3,000. So what you are able to do each year is go, well, if my actual expenses multiplied by the percentage of use equaled out to $3,000, you could do that, or you could do the standard mileage rate. Now I'm going to go ahead and pull up my calculator, because just because you're a CPA doesn't mean you're any good at doing math quickly in your head. And I don't believe doing math quickly in my head, because if I do math quickly in my head, I don't get to bill my client as much. And now, of course, you know, I'm laughing and kidding, but that's a joke I tell my clients all the time. But if you were to say you drove 3,000 miles, and let's just go to 2023, and you get 65.5 cents a mile, then that would equal a $1,965 deduction, where your actual expenses at the 30% yielded a $3,000 deduction. So you'd be able to take the higher of. And one of the things to note is that you can make that decision all over again in the following year. So great question on that. Typically with my clients, we say, hey, just go with the standard rate. Now, in the simple example I gave you, if a client was filing a Schedule C, which I'll tell you this right now, I only have 2 clients that I allow to be a Schedule C. If they're involved in their business, they're an S Corp. If they won't become an S Corp, we fire them. So with that being said, if you're filing the Schedule C, maybe you have your reasonings for it. Maybe you're just getting it off the ground. Maybe you're not netting enough yet to make it worth to have an S Corp. But if I had a client filing a Schedule C, we would still do the analysis. Mileage would be the easiest way, but if you noted, you still got to track your miles either way, whether you're doing the mileage method or doing actual, because you would have to know how many miles were for business. All right, Amanda, that was too long of an answer. I got to be quicker now. I got to be quicker.
All right. This was from Tina Beard, CPA.
Oh my gosh, Tina, how are you? Good to see you. Tax season is here. Can you believe it?
Can the owner of a single single member LLC sell their membership to another individual and the new member continue to do business under the original LLC's FEIN?
So in a very simplified understanding of your question, the answer would be yes, because if that LLC is a legal entity, which obviously it is, that LLC then was assigned an FEIN, that's a federal ID number. Of course, Tina knows that. But with that being said, that ID number is attached then to that LLC, as you know. So whether it had multiple owners of it or not, when that LLC sells, there's still units that are associated with the LLC. So when we have LLCs, and Tina, you know some of this that I'm already saying, I'm just saying it for the benefit of everybody tuning in. But when you have an LLC, you don't have stock, you have what's called units. It's the same thing as stock, but it's not called stock, it's called units. With an LLC, then if it means that there is a single member, it just means that there's a one owner. So whatever units there were, let's just say it's 10, it could be 100, it could be 1,000, but whatever units there are, then that means that only one person owns any of the units that are outstanding with the LLC. So what it means, though, is that it doesn't change the fact that it's a legal entity and it has an ID number with the IRS. So if that is sold, the assets inside of it are also sold, then it would be no different than if it was a partnership or an S Corp, meaning it's going to be a legal entity that was sold. And if they literally did sell then the units, that's what's key here, they sold the units, then whoever bought those units, they take over that LLC and they take over the EIN. The IRS actually wouldn't let them do anything different. If you bought this LLC with this EIN, then you are taking that on. And then the new owner, if we're talking about a single member LLC, that means that they could have been a disregarded entity filing a Schedule C, Schedule E, Schedule F. Well, then that new owner could elect for it to be a C Corp, an S Corp, or if they had another owner come in, they could elect for it to be a partner. That's that new owner. The reason I'm mentioning that is that there's no requirement when we go from a single member LLC other than potentially a C Corp and an S Corp. But if we're talking about somebody that really didn't file a separate tax return for the LLC because they weren't required, then that new owner kind of can do whatever it is that makes sense for them. Now, if they had a single member LLC, and I don't think this is what you were asking, Tina, but if they had a single member LLC and it was just, well, this is a one owner S Corp or a one owner C Corp, well, then of course you would know, everybody would know, then the buyer of that LLC would need to continue it in that same tax classification with the S Corp for at least 5 years. The C Corp, they would then have to make an election to change that. But I think most likely you're not going into the S Corp or C Corp route. So short answer is yes. And then of course you already know this, but for those listening, when you sell units like stock, if you've owned it over a year, then you would be able to get capital gain treatment unless you're a person who like put together that entity and organized it. Then you'd have to own it for 3 years, but that's not going to fall into these circumstances. Point is, then that should be a capital transaction because you just sold units and then taxed any way that it would fall under the laws of capital gains or maybe even losses related to that. So great question and great to see you. All right, Amanda, I got to be quicker.
This is from Mr. A. Do you have any good trainings advice on learning the nuances when it comes to depreciation, primarily when bonus 179 and MACRS methods should be used?
Well, I would probably say you could start with, it's definitely not going to be as encompassing probably as other resources, but I do have a video. I don't have a thumbnail to throw up for you. But if you just go through my videos, I came out with it a couple of months ago. It's about 20 minutes long, and I walk through the depreciation. But one of the things that I talk about in that video when we're talking about strategizing, so makers, the MACRS, makers is just your traditional assigned amount of depreciation that's taken according to the IRS. And typically And Mr. A may know this, but typically with makers, it's a little bit higher and then it goes down a little bit. But with that being said, makers would be typically just, here's what I'm going to take each year over the class life. So vehicles are over 5 years, furniture and equipment are over 7 years. Software, you get to expense. Computers under $2,500, you get to expense. But with that being said, if you have an asset and it's typically above $2,500, then you're trying to figure out, well, is it a 3-year asset, a 5-year asset, a 7-year asset, 10, 15, 20, 27 and a half, 39 year. So once you figure out what the class life is, and the IRS tells us, so as an example, you would have, let's say, some furniture and equipment. Well, it's a 7-year asset. So under makers, you're going to get that deduction over 7 years. Again, it'll be a little higher in the first year, a little lower, but it'll be that you got to write it off over the 7 years. So the first thing I tell clients is no matter what, assuming 100% business use of the asset, you're going to get the deduction. Then what you look at is under Code Section 168, which is bonus depreciation. In 2023, you're able to write off up to 80%. Now, if you bought the asset in 22, you can write off up to 100% of that business asset in year one. Now, it's the only year that you're able to do that. When do we have a caution related to that? Well, what we also are dealing with is now in the law that went back into play in 2021 is excess business losses. So excess business losses are for those that have an S corp or a partnership and they have losses that are non-passive and they have basis. And on Schedule E, page 2, there's going to be a loss overall that would then flow into Schedule 1 that flows then to Schedule or a Form 1040. And the IRS limits that loss, and it's well over $500,000. But with that being said, we then try to be strategic. If we have a client and they have a ton of asset purchases in a particular year, and if we elect bonus depreciation, it can create a loss, meaning if we have income and expenses, and then we take into account the bonus depreciation, which is in 22, 100%, this year, 80% of that cost. Well, then when we take those into account, it may be that there's a loss. But if that loss is going to be greater than the allowable loss, meaning it's going to become now an excess business loss, then that would be the year that we go, hey, I don't know if we want to take as much bonus depreciation. Now, one of the things about bonus depreciation, and I talk about it in that video, and I bring up the slides that are from my seminar about the depreciation. But the thing about bonus depreciation is that you have to treat all class life the same. What does that mean? So if you put into, you bought and placed into service some furniture and equipment in 2022, it's 7-year property. With that being said, then any property that you placed into service, bought and placed into service just means you started using it for business. Then on all 7-year assets that were bought and placed into service in 2022, you have to treat it the same for Code Section 168, meaning if you're going to allow bonus depreciation to continue, because it's automatic, you have to elect out of it. But if you're going to allow that, then all new or used, but new to the company assets that are 7-year that were placed in service during 22 have to be treated the same. So that's the trickiness when we're talking about Code Section 168. Might be more tricky when we're talking about qualified improvement property that's now 15-year. The CARES Act fixed that glitch, and that can be on commercial real estate. That could be a real circumstance. And then what we look at is the third option, as you mentioned, which is Code Section 179. It's just an IRS code section. But under Code Section 179, the big difference between that depreciation code section and Code Section 168 is this. Code Section 179 depreciation can only be taken to the extent of the net income of that business. Now, if it's an S Corp or a C Corp, you can take it to the extent of officer compensation. And then tax pros, you're going to know down at the individual level, there could be other limitations, yada, 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 right? We can't go into every circumstance that exists related to 179. But the big difference is 179 depreciation is only taken to the extent of net income. So let's just say for grins that somebody has net income of their business of $100,000 before they decided what they were going to do with depreciation. So, Mr. A, this would be an example to answer your question. Let's say they have net income of 100 grand, and now they're trying to figure out, do I want to take makers, which is a little bit over time? Do I want to take 168, which depending on the year, it depends on the percentage, but you're getting a big deduction up front, or do I want to take 179? So the bigger picture of the tax planning is, well, of that 100,000 of that net income of this business, whether we're talking about an S corp, a partnership, or Schedule C, Schedule E, Schedule F, that 100,000, well, what is the tax rate of the individual that's actually going to now account for that income? So let's just use an example that somebody has other wages, their spouse has wages, they have other income, and they own then this business. Then let's just use a blended rate of 30%, which means this, that 100,000, if there was no depreciation taken, and that individual is going to recognize it as income of 100,000, and if they're in the blended tax rate of 30%, that means they're going to owe $30,000 in taxes. Now, they may have paid it through estimates and withholdings, but the tax ramification of that net income is $30,000 in this example. So with that being said, let's just say for grins that somebody buys $200,000 of new equipment. So new equipment, that's going to be a 7-year asset, which means that the IRS is going to allow it over 7 years. So with makers, it's not 1/7. I'm just going to pull a number straight out of the hat. And let's just say for grins that on a $200,000 asset, and I'm pulling something literally out of the air. Let's say that that's a $40,000 deduction, okay, using makers. Well, what did that $40,000 save that owner of the business? Well, if I take 40,000 times 30%, that's their tax bracket, they'd be like, well, that's going to save me 12 grand in tax, meaning makers yielded a $60,000 deduction on the $200,000 asset. And that's then going to save that person, let's say 12 grand. If I said 60 grand, I meant 40 grand. You can always watch it back. Now we look at, well, what about bonus depreciation? Well, bonus depreciation, we'd say, well, if it's a $200,000 asset and they have 100,000 of net income, then that 200,000, let's assume we're talking about 2022, well, that's going to completely wipe away the net income, and there's going to be $100,000 loss, right? 200,000 net income, and now we take into account 200,000 of bonus depreciation under 168. That's now $100,000 loss. But what we'd want to be mindful of is we know that immediately is saving them $30,000. But when I now look at the individual level, and we go through this exercise a lot with clients, if it now has $100,000 loss, then what's that loss saving them additional in that year? Now, when I was a young CPA back in my 20s, many small business owners, we wanted to take as much deduction as we could up front. Now, as we've gotten older, meaning me, my clients, we're a little more sophisticated in the sense of not as gung-ho about just zeroing out tax. So let's just say for grins that $100,000 loss, which would potentially offset the other income on that individual's tax return, that would assume they have basis and that it's non-passive. Let's just say, though, that 100,000 that's been wiped away now puts them in the tax bracket blended rate of, let's say, 22%. So that loss is only going to save them $22,000, meaning 200,000 of the bonus depreciation was taken. The first 100,000 is going to save them 30 grand. That $100,000 loss, we're talking about 22 here, is only going to save them 22 grand. So if I were to say, well, what if we did Section 179 depreciation? Well, that $200,000 asset, we'd be able to get all of it as a write-off. There are limitations up to only $1 million is allowed in any given year, but obviously in this example, we're well below that. So you would say, okay, well, we've got 200,000 in Section 179 depreciation, but it's only going to be taken to the extent of the net income. So the 100,000 would be allowed, which means it wiped that 100,000 of net income away on that individual's tax return. But then that 100,000 is just going to carry over to the next year. Now, this is where the sophisticated tax planning comes into play. Well, what's our tax rate going to look like for this client next year? Well, with many of my clients where we are in our careers, pretty much the same, kind of can count on pretty much the same type of income, which means that client next year will be in the 30% bracket if they're expecting to net the same kind of income, which means that extra 100,000 of Section 179 depreciation not allowed in the current year, yes, was not a deduction that cost them 22,000, but by that depreciation under Section 179 being carried to the next year is going to save them 30 grand in the following year. So collectively under Code Section 179, in my example, between the 2 years, that would be a $60,000 savings. Whereas if it was all taken under 168 in 2022, then it would only save that person 52 grand. Now, for many small business owners, they're like, I'd rather save 52 grand now. I can worry about that later. So kind of just depends. But that's then the strategy that we would look at is, how much does that tax save me on makers? How much does a tax save me on 168? How much does a tax save me under Section 179? But also keeping in mind, does that somehow put me in a lower tax bracket? Because a novice, which may not be you, but a novice would say, hey, any deduction's a good deduction. True. But a deduction that is so great that it puts you in the lowest of tax brackets is not as valuable as if you would be able to take it over a year or two. So many may look at it and go, well, I don't want to do 168 and I don't want to do 179. I want to do makers, because then over the next 7 years, if I'm always expected to be in the 30% bracket, then I'm going to save a little bit over time for the next 7 years. So it kind of depends on cash flow, depends on the temperament of the client, depends on what their outlook is for the future. So with that analysis, which we went deep, I want to say thank you for that, Amanda. We are past what we had indicated. I said we're going to go another 15. We went another 25. We still got 61 individuals on us. Pop up real quick, Josh Jalinski for me, if you will. Josh Jalinski has become a great friend. Here is his book. And I will put a link, if I don't have it already, I'm going to put a link in the body of this video. But Josh Jalinski was kind enough to have me on his show. If you're not familiar with him, The Financial Quarterback, which he also trademarked, but he has a radio show that is nationwide on iHeartRadio and also on a couple of stations in the New York area that goes up and down the East Coast. Richard knows who the Financial Quarterback is, Josh Jalinski, but he has become a great friend of mine. And when we were kind of in the midst of the pandemic and I was getting my channel getting recognized, he had me on his show a number of times, and we talked about PPP and the EIDL, talked about the ERTC. So with Josh, he is a financial advisor, licensed, has many clients. We have a lot of similarities. He's a great guy. And he's had me on his show a number of times. He now has a YouTube channel, which, by the way, Amanda, let's make sure I put a link to that YouTube channel in the body of this video to Josh's. But with Josh, he has been so generous in having me on his show. Well, I've never had a guest on, right, Amanda?
Right.
We've never had a guest on. Nope. So with this software, we have figured out how to have a guest. And with that being said, Josh, I told him, I won't have a guest on until I have you on. So once we figure this out, then we want to have you on. So why am I telling you all that? Well, I'm looking forward to having Josh on. When? Still don't know, because now that we figured it out, which was just today, now we can reach out to Josh and get that scheduled. It'll probably be maybe next week. And then I am going to be having a podcast that's going to come out. And it's not a big deal because anybody can do a podcast and throw it up on iTunes, but it'll be on iTunes. I think it also gets up on SoundCloud and whatever the other things are. So I've been doing some recordings, but I'm going to start releasing those probably in February. They're not going to be anything like what's on YouTube or anything like the live show. It's going to be topics that kind of cover 20 minutes and all you're doing is listening to me. So they're not as animated as you getting to watch me. But with that being said, When I indicated that I was going to have a podcast coming out about a month ago, CSR was kind enough to say, hey, if you ever need a guest, someone to chew the fat with, if you will, those are my words I added, not his, let me know. So we would love to have CSR on as one of our first guests as well. So look forward to that. And I'm sure that some of our other favorite longtime YouTube friends, family members with flying colors we had on by phone, not by video, but with flying colors the day that her book came out, we had her on. But you can also get this book there. So, all right. Amanda, was there anything pressing that we missed? And you wouldn't even tell me if there was because you're ready to. No, I'm kidding.
I would, but I would tell you that there are.
Oh, I know. Oh, no. All right. So we've gone an hour and 40. I know that probably CSR would have a wager going with several. Will there ever be a time when we actually keep this show to an hour? And I think yes, because we did do a show for a period of time in the fall called JJ the CPA's Small Business Toolbox. And
Tell you what we need to do. We need to, every day that you just do an hour, we put that date in a jar, and then then at the end of tax season, we'll just draw out a number, and then somebody will just get a prize.
Okay. All right. Yeah.
So,
maybe we got to come up with what the challenge is, because the
That's
prize should go to CSR. He's always the one that's paying attention to our times, and he's always usually, I want to say, I can't think of a time that he wasn't first thumbs up unless Rob beat him. Unless Rob beat him. All right. Well, listen, thanks, Gary, for letting me share things about you. I probably should mention too, we're going to talk in the next couple of weeks about Tijuana Jackson in terms of, well, what does that have to do with anything? And I've got a book, JJ the CPA here. It's an immortal set of advice that I've given to clients over the last 30 years. And with that, Amanda, I think we are out of here.
Yes.
Greg wants to say roll tide.
Roll tide, but then he wants us to bring back drinks on Friday.
Okay. The Fridays that we were here, and I will tell you this, I think Friday the 27th of January and then Friday the 3rd of February, we definitely won't be. So we might have, my point in saying that is we might have to do that on a Thursday.
Yeah, maybe.
But yeah, so for those that weren't tuning in, which probably most of you were, but during the kind of the height of the shutdown, Robert of Philadelphia Salons sent us and had delivered to us food and supplies from Target right as we were going live one time. And so we, on our very first time of doing a happy hour, we were sharing what Robert of Philadelphia Salons had sent us. And then it really became a tradition after that, on Fridays at 4, we had a happy hour. Now, happy hour can be water, can be Coke, could be coffee, could be something stronger. So we definitely don't want to encourage anybody to drink anything stronger than they need to. Plus, we also know our great friends on the West Coast right now, they're 2 hours earlier than where we are here in Oklahoma. Might be too soon to have a stronger drink. And with that being said, I think we're ready to rock and roll and call it the end of the show for our first inaugural tax season of 2023 live talk show. Think we're good?
We're good. Thank you, guys.
All right. Well, thank you so much for being here. We had so many more. I told Amanda, I said, well, when we had Small Business Toolbox, it seemed like we average right around mid 40s in terms of those that were on. Seems like every once in a while we get up to 50. Seems like today we've averaged about 60 tuning in at any given time. So thank you for that. Tell your friends about this show from the standpoint of we're here for Q&A, here to help, here to provide answers. We know that taxes are complicated. You know as well as I do that if I don't know something, I tell you, so I won't lead you astray. I'm always a fan of using a tax professional, but at the same time, I know there's many out there that aren't quite there yet in hiring somebody. So hopefully I'm a resource for you. Patrick Clark
Is on.
Is on. Oh,
Yeah.
my good friend Patrick Clark. Well, I could tell stories about him, all of which are good. Hey, let's throw up real quick. We got our boot camp this Friday, so check that out. Basically, I'm going to be walking through. Scroll down a little bit. Scroll down. Boom. Scroll down. There it is. Nope. 3 more. It says 113 seminar. Go down.
Oh, sorry.
There it is. All right. So we have our tax season boot camp seminar, counts for CPE if you're there live. If you can't make it live, you can rewatch it. Also have the package deal. And then we also have Group 51, which we'll talk more about once we're done with these next 2 seminars. All right. With that, thanks for tuning in. I'd love it if you subscribe. And then don't you ever forget, you've never met a CPA quite like me. Y'all have a great one. Uh-oh. Didn't have it ready. Here we go. 3, 2, 1.
American CPA. CPA.